People imagine a collapse as a cliff, a sudden crash, a currency panic, a visible default. But some systems don't fall like that. They don't break, they bend. And what looks like stability becomes something else, a long, slow, controlled stall. China's debt problem is often described as a time bomb, but the real danger may not be an explosion, it may be a freeze. Because when a country builds its growth on property, leverage, and local government land sales, the collapse pattern doesn't have to arrive overnight. It can arrive as muddle through, extend the loans, hide the losses, keep the lights on, and slowly trade growth for control. So the question isn't only, will China collapse? It's this. Is China heading toward a Japan-style outcome, a long plateau where the system survives but momentum never fully returns? To understand China's debt story, you have to understand its golden age. For decades, China ran one of the most powerful growth engines in modern history. Factories expanded, infrastructure spread, cities rose from farmland, and millions moved into the urban economy. At the center of that engine was a simple model: build, borrow, grow. Local governments competed for development. Banks supplied credit. Developers turned land into apartments. And households poured savings into property because property became the safest-looking bet in the system. For a long time, it worked, because rapid urbanization and rising prices made the leverage look safe. But that is always how it starts. In the golden age, the system looks stable because the asset you're inflating is the asset everyone believes in. Now we enter the acceleration phase. The mistakes were not one dramatic villain moment. They were incentives stacking over time. The first mistake was this: property became the national balance sheet. When housing is not just shelter but the main store of value, the entire economy becomes tied to property prices, household wealth, developer cash flow, local government revenue, bank collateral. Everything starts to orbit the same asset. That creates a fragile dependency. If prices stop rising, the machine doesn't just slow, it loses its narrative. The second mistake was hidden local government debt. Local governments don't always borrow in the open, they borrow through layers. Financing vehicles, quasi-state companies, projects backed by expected land sales, and future growth. In a boom, that looks like investment. In a slowdown, it becomes a debt trap. And because land sales were a major source of local revenue, property prices weren't just a market issue. They became a fiscal foundation. The third mistake was the extend and pretend incentive. When credit is widely held by state-influenced banks, a slowdown doesn't always force immediate recognition of losses. Instead of default, you can restructure. Instead of bankruptcy, you can roll the loan. Instead of liquidation, you can merge and rename. This reduces visible shock, but it can lock the system into low growth. This is the beginning of the Japanification pattern. Bad debt isn't cleared quickly, it is carried. And carrying bad debt has a cost. Capital stays trapped in weak projects. New productive growth gets crowded out, and the economy becomes less dynamic over time. Now the feedback loop flips. Once property demand slows, the model gets exposed. Developers who relied on constant pre-sales lose cash flow. Projects pause, confidence weakens, households become cautious. Then the cycle reinforces itself. Falling confidence reduces sales. Lower sales reduce funding. Less funding slows construction, and stalled construction reduces confidence again. This isn't only financial, it becomes social, because property is where household expectations live. If the safest bet stops feeling safe, behavior changes. People save more, spend less, take fewer risks. Here's what makes China's situation different from many Western crises. A Western-style crisis often ends with visible bank failures, a sudden currency crash, or a formal sovereign default. China has tools that can delay those outcomes. Capital controls can slow flight, state banks can be instructed to roll loans, regulators can freeze parts of the market, and the central bank can inject liquidity. So instead of a loud collapse, you can get something quieter. A series of managed restructurings, a slow grind, a long repair process, not a cliff, a plateau. But the absence of a crash is not the same as health. That's why the time bomb metaphor can mislead people. The danger isn't only what happens in one day, it's what happens over many years when growth slows and debt remains. So what does a Japan-style path look like? Japan taught the world a difficult truth. You can avoid a hard landing, but you may pay with decades of weak growth. And the trade-off is simple. The more you protect the old structure, the harder it becomes to build a new one. A Japanification path often includes low rates for a long time, quiet bank support, restructuring that takes years, not months, public balance sheets absorbing strain, an economy that remains stable yet stagnant. China has its own version of these dynamics, debt that is rolled forward, property adjustment managed rather than cleared, growth targets that reward stabilization, and a strong preference for control over disorder. The deeper cost is confidence and expectations. In a fast-growth society, people believe the future will be bigger than the present. In a plateau society, people adjust. They stop expecting rapid gains, they become cautious, and the economy becomes more defensive. That's how stagnation becomes self-reinforcing. And beneath that is the real pattern. A golden age built on leverage creates a system that cannot easily deleverage without changing the political and social contract. If you tighten too hard, you risk disorder. If you loosen too much, you risk trapping the economy in high debt and low productivity. So leaders choose the middle path, muddle through. So is China heading toward collapse? The more accurate question is, what kind of non-collapse is being engineered? Is the system heading for a sharp reset that clears debt quickly, or a long plateau where debt remains and growth never fully returns? Avoiding collapse is not the same as staying healthy. You can keep the system standing by extending losses, smoothing shocks, and controlling exits. But you may end up with the same outcome Japan faced, a country that is stable, functional, and safe, yet permanently slowed. China's debt story may not end with a bang. It may end with a long, controlled silence, a system that survives by refusing to let certain things break. But every time you prevent a break, you choose where the pressure goes. Sometimes it goes into the future. On this channel, we don't just tell history, we decode collapse patterns step by step. From Spain's silver boom, to Britain's overstretched empire, to the Soviet command economy, to Japan's long stagnation, and now to China's debt plateau question. If you want to see how these stories rhyme and what stage today's systems may be in, subscribe to Collapse Pattern. Don't just watch history happen, see it coming.